Kashyap, thanks so much for joining us on ET Now. Of course, you also have the Access Auto Conference going on, so it's on the sidelines of that he's joining us. Kashyap, like even our technical analyst pointed out, there seems to be a lot of resistance at higher levels of 10,400, etc. It's making the market really nervous. It's I think the second day where we are seeing significant selling pressure come by in the last 90 minutes or trade. What do you think the risks are for the market currently? Is it emanating from global factors like the Trump trade war? We also have domestic factors like elections. We did see a big loss coming by for BJP. So where do you think the risks lie currently for the Indian markets?
So I think if you look at markets over the last 2 years, the stock prices did extremely well. Earnings actually were lagging the prices, and the macro was very strong while the micro underpinnings were weak because earnings growth was not coming through. I think going forward, the way we see it is that macro is actually turning a bit weaker. So all the factors that you spoke of in terms of rising rates locally and globally, uncertainty as far as trade policy is concerned overseas, elections back home, is all basically causing a doubt on the overall macro. It's not alarming yet, but it's definitely some headwinds that have emerged. As far as the micro is concerned, the micro underpinnings have been solidified because we are seeing post GST a move from unorganized to organized. We are seeing companies deliver good performance. In fact, Q3 was one of the best quarters in the last 4 years, where Sensex earnings ex SBI I think grew handsomely. Our coverage universe, the earnings grew 20% in this quarter. So essentially what our sense is that even though earnings might come through going ahead, I think because of the macro which is turning a bit weak, we might be in a situation where PE multiples compress, and I think that is the key reason why we will see volatility in the market, because the valuation that we are at is, even though we have corrected, we are still reasonably high. It's still a huge premium, especially for a lot of mid-cap stocks. So my sense is that given that rates have gone up, your multiples need to correct a bit, and if earnings don't sufficiently stack up, you can't justify some of these multiples, and it is because of these factors that the market this year is likely to be very volatile, and this is going to be more of a stock pickers market, where one will actually have to be bottom up and actually see where the returns are and then take a call on allocations.
But Kashyap, you spoke about valuations, and the Q3 earnings were they were not bad. Let's say there was no bad news as such. But do you think that post this correction, maybe valuations in some pockets may have actually improved?
So it's obviously that case that if you look at the market overall, where we see comfort, I can speak about that. I think the consumption space in the market, which has been one of the most favored space in the last couple of years, we are not seeing any significant compression there. I mean, if you look at the IRRs that one can make by getting into consumer staples or discretionary or retail, we are more or less around 8 to 9% IRRs there. So the multiples haven't really corrected enough there. When you look at it, when you look at engineering, it's a mixed bag. The engineering MNC names are pretty rich, and too much of earnings, the expectations are built in at these multiples. But when you look at the multinationals, you look at some of the local names, we see some valuation comfort in those names. When you look at auto, I think auto is a place where we clearly feel there is reasonable comfort on valuations and earnings growth both. So if I were to play a discretionary spend, I would rather play it through auto rather than playing it through a consumer durable or a light electrical company, that people have traditionally played in the last few years, because the multiples there are still too demanding, whereas auto has a reasonable set of expectations built in at the current point in time, and I feel that that's a good space to allocate. So even IT, when you look at it, we are still seeing a reasonable comfort when it comes to IT, because the intrinsic, I think the value or the IRR expectations there are still in double digits. The stocks have not done anything meaningfully, and our belief is that the larger names especially will exit Q4 FY19 with maybe a double-digit revenue growth trajectory. So on an incremental basis, we see the momentum building up, and the valuations are reasonably comfortable.
It's interesting you spoke about auto, but just this morning we were talking about how we have stocks like Maruti and Eicher, which delivered phenomenal returns for the year 2017. But if you look at on a year-to-date basis, these stocks have actually not been able to do much. But again, there has been weakness overall in the markets as well. Similarly, even the monthly numbers, there was a bit of tempering, if not a decrease definitely, but there was a bit of tempering in terms of growth for Maruti. Do you believe that now going forward we'll be working perhaps with a high base for most of these auto names, and of course given the sharp run-up we have seen in 2017?
So I think let's take two things, in different context. One is the run-up and one is the headroom. So I think if you look at it from a consumption perspective, you look at countries like China or maybe other countries. I think India, when it comes to four-wheelers, there is still huge room to penetrate, and there is huge amount of potential in the company that you spoke of, where one can actually keep premiumizing because they have one of the best product portfolio and distribution. Now, when you look at the size of the total automotive as to India, how many cars are sold during the year, it's actually a fraction of what it sells in China. So our sense is that the runway is still very long. Now, second is that as your earnings or your per capita incomes move up and people have rising aspirations, this is a great category to allocate to play the discretionary spend rather than play it through a durable. So if you just look at the multiple, even after Maruti or Eicher or whichever of these companies, they have gone up quite substantially in the last 2-3 years, and you compare it with how consumer durables trade today in the market, you'll see tremendous value still in actually playing the discretionary spend through the automotive route, then through the white good route. Now also this entire expansion of price is relative, because when you look at it in the last 5 years back, and if one were to draw up an IRR exercise 5 years back, stocks like Maruti, Eicher and maybe the entire automotive pack would have actually demonstrated an IRR of 25%. So today, when after 5 years, when the IRRs are around 12-13%, I feel it's still good enough to buy, because it's in healthy double digits to look at, because they are post-tax IRRs at the end of the day. So I think though the stocks have run up in the last 4-5 years, we still see a good amount of headroom going forward from a pure perspective to compound money at a steady pace.
Okay, point taken. So it's better to play the discretionary space via autos as compared to white goods or even consumer durables for that matter. I want to take your perspective on financials. One thing's for certain, that when it comes to the private retail space, the private banking space rather, the NBFCs, one thing's for certain, that these are the guys that are going to take away market share from PSU banks naturally, because PSU banks are going to be hesitant now to lend money. So the growth prospects for this pocket does look strong. But on the flip side, again, valuations is something that's perhaps keeping investors away from most of these HFCs and these NBFCs. So what side of the argument would you stand on? Would it be the valuation part which would concern you, or again, would it be the growth story that does look very promising?
So I think valuation obviously is very important, because if your entry price is wrong, or if you go wrong there, it's very difficult to make a return, because you'll have to give up a few years of compounding to actually come in the black. So obviously entry point is very crucial. But having said that, your thesis about PSU bank versus private banks, that has been an age-old thesis. At one point it were only PSU banks, and today still we have 30%. That's the only market share of private sector banks. So to that extent, I think the private sector banks have demonstrated over time that they've been able to gain share, and there is still huge amount of gain yet left, given that 70% is still with PSU banks, and that too with extreme fragmentation, because there is a small bank, big bank. So I think over time there would be some consolidation hopefully, and things will get more even playing. But nevertheless, I think this debate that you just spoke of has always remained, and I think this will only accelerate going forward. So I clearly feel PSU private banks are a preferred spot to be in, and even NBFCs today. Like if you look at, there are a lot of specialized NBFCs who have really stood the test of time and have done a great job when it comes to growing well, with asset qualities being under extreme check. And I think those are the companies which will continue delivering and continue getting those multiples, because at the end of the day, in this business, it's all about how you grow and how you manage your asset quality at the end of the day. Because mind you, the leverage in NBFCs or in the financial sector per se is very high. So if you are actually lending but not able to collect, it's clearly an issue. So there, I think we have seen a case in NBFCs as well, where men and boys have been separated, where you are seeing a certain set of NBFCs who have demonstrated track record of growth and consistency of asset quality, which are valued, and I think the street is right in giving them that valuation.
Okay, so I think that more or less brings us back to the first point you had made, Kashyap, to be stock specific. Thanks a lot then for joining us on ET Now.